At 43 years old, Tom bid farewell to his routine job at Ford Motor, having accumulated wealth through prudent savings and astute stock market investments, despite being penniless at his college graduation. He earned his degree in mechanical engineering from the University of Michigan, Dearborn, when he was 23, following in his father's footsteps. Before even completing his studies, Tom secured a position at General Motors, a move his family greatly admired. However, inwardly he wondered, is this it? Always desiring something more divergent from what his contemporaries anticipated. His initial tenure at General Motors only deepened this sentiment. Upon meeting his supervisor, James, a veteran employee honored with a golden watch for his tenure, Tom's perception began to shift. James was visibly proud of his timepiece, but Tom saw him still stationary, engaged in the same tasks he'd been doing since he was Tom's age. James seemed to be living a life obligated to his duties rather than fulfilling his desires. This realization was underscored during a lunch where James enthusiastically discussed wild boar hunting. Instead of exploring ways to enhance the assembly line at General Motors, Tom had witnessed a comparable scenario with his father, a hiking enthusiast confined to infrequent excursions due to work demands. Peculiarly, earning money seemed to be costing them dearly in other ways. This video will guide you through the 3 phases Tom navigated to achieve financial autonomy. You'll observe how priorities shift at each stage, but take heed of a crucial point from the outset. Without investing, if Tom had sought to amass his target of $1 million solely from his engineering salary, this story would have been told at age 57, not 43. Investing allowed Tom to reclaim 14 years of the most valuable currency, time. Discover what captured Tom's attention as a stock market investor. His focus is beyond the investment realm, and, crucially, the paths he chose to avoid. Stage 1. Tom's journey from $0 to $20,000. Welcome to the initial phase, or the kickoff stage. If you've already conquered this milestone or have surpassed it, kudos. Stay tuned though. We'll soon delve into your present stage. Tom's enlightenment about finances came unexpectedly during a day at the library where he had gone to fetch 1984 for his quarantine-bound mother. He literally tripped over a copy of The Richest Man in Babylon, distracted by a charming red-headed librarian. While she giggled at his stumble, Tom noted the back cover of the book promising a certain path to happiness and prosperity. Intrigued and somewhat embarrassed in front of the adorable librarian, Tom decided to borrow the book. Pay yourself first became a mantra that the book impressed upon Tom, encouraging him to allocate 10% of his monthly earnings to himself before managing any other financial obligations. Tom saw this as the piece missing from his supervisor James's financial strategy, who seemed to pay everyone, Sitka, Night Force, and American Airlines, except himself. Getting to know James better, Tom realized that James didn't prioritize his financial self-care at all. Not that it was intrinsically wrong, but it appeared not to be the best formula for achieving paycheck independence. Choose wisely how to spend the time given to us becomes pivotal during this primary stage. Pay yourself first. The stock market can effectively transform a reasonable sum into a significant one, although it's not the best tool for augmenting a minimal amount. In the early stages of your financial independence journey, approach the stock market like a Swedish smorgasbord. Sample a little bit of everything. Just like you need to taste a meatball to understand its flavor, experiential learning is essential with stock market investments. If you're advised to invest with play money or a simulator, politely decline. Beware of the financial fermented fish, though. Tom assimilated this lesson through a somewhat rough journey. After The Richest Man in Babylon, he explored Robert Kiyosaki's Rich Dad, Poor Dad. Although he missed another serendipitous encounter with the cute librarian, he grasped that the stock market was an exemplary place to turn savings into assets. But without prior investment knowledge, he found himself lured by speculative biotech company tips on Reddit. The initial phase went splendidly, with his $5,000 doubling in a mere week. However, the expected downturn of this strategy came soon after, with his capital plunging by 60%. His personal fermented fish was investing in unprofitable nanobiotech companies, subsequently tumbling from the peak of inflated expectations into the trough of disillusionment on the Dunning-Kruger curve. Tom hadn't yet discovered Warren Buffett, but inadvertently learned his key rules. 1. Never lose money. And 2. Don't forget rule number 1. Despite the percentage of losses being horrific, in dollar terms they were bearable. Tom replenished his losses within 2 months with his salary. Unlike a coworker who had staked everything on a new cryptocurrency and thereby guzzled an entire can of fermented fish, Tom was still in play. But he recognized that as his savings swelled, the stakes would too, and blunders would be increasingly costly. Thus, Tom vowed to transform into a learning automaton. During meals, he'd watch his preferred financial YouTubers. During walks, he'd listen to favored podcasts. Gradually, Tom was climbing out of the proverbial despair valley. Tom managed to traverse from $0 to $20,000 in just shy of 2 years by allocating $1,000 from his monthly salary as a junior engineer at General Motors, enduring a loss of approximately $2,000 from investments in unprofitable nanobiotech companies, and squandering $1,000 on brokerage commissions. Indeed, Tom was an active trader initially. Tom was far from a stock-picking maestro at this juncture. Indeed, it was his savings that bore him all the way, this time around. Stage 2. Tom's journey from $20,000 to $100,000. As Tom ushered into his third year with General Motors, a financial conversation with his father awaited him. It wasn't the typical birds and the bees discussion, but rather an offering of a financial boost. His parents, recognizing his diligent saving habits, offered to contribute an additional $10,000 towards perhaps purchasing a home of his own. It was a tempting and potentially luxurious opportunity. However, hidden within it was a financial snare. Despite not yet being acquainted with the wisdom of Charlie Munger, Tom knew something from Robert Kiyosaki. Houses are liabilities, while the objective is to accumulate assets. With polite gratitude, Tom declined the offer, allowing his money to continue working for him in the stock market. The hallmark of the second stage in the financial journey is the substantial role the stock market plays. A substantial portion of the $100,000 ought to emanate from market returns, otherwise, you'll find yourself shouldering a burdensome workload. Although the increasing financial capacity may render you capable of affording luxuries like a new car or a house down payment, it's crucial to resist these temptations. The compounding needs to be left uninterrupted, especially now that it's beginning to gain momentum. By age 27, Tom became deeply entwined with stock market company analysis. Recollecting the aftermath of his previous speculative investments in nanobiotech companies, he pivoted towards investing only in what he could comprehend and quickly evaluate using a rough discounted cash flow (DCF) analysis. He was guided by Warren Buffett's philosophy of seeking investments easy enough to simply step over rather than attempting lofty leaps. Suddenly, an unexpected call from Stephen, a financially astute old-school friend, presented Tom with a seemingly lucrative investment in a startup touted as the Walmart of the metaverse. Despite the temptation and trusting Stephen's financial judgment, Tom found himself aligning more with the investment wisdom of Peter Lynch, aiming for businesses simple enough for any individual to run, as eventually it's likely an ordinary individual will. So Tom opted for a minimal $500 investment, much to Stephen's amusement. Instead of seeking complex investments, Tom chose simplicity and familiarity. He invested in Google, Microsoft, and Walmart, focusing intently on the price, and driven by the realization that errors at this stage could be significantly impactful and set back his financial freedom journey by potentially years. Tom didn't cease his education, continuing to consume information and hone his investment strategy. On one trip to the library to fetch Howard Marks's The Most Important Thing, he stumbled, both literally and metaphorically, upon the red-headed librarian Sarah again. Following a charming and teasing exchange, subsequent visits to the library became more frequent. Eventually, Tom mustered the courage to invite Sarah on a date, which unfolded beautifully. Their shared penchant for books and frugal living led them to bond over reading and chill dates, which often encompassed more than mere budgeting discussions. When Tom and Sarah consolidated their lives moving in together, their combined financial strategy and shared expenses resulted in enhanced saving capabilities for Tom. Moving to a slightly larger apartment still resulted in cost efficiencies when splitting rent, and Tom, climbing the career ladder, managed to augment his monthly savings from $1,000 to $1,500. With an average annual stock market return of 10%, Tom, by his 29th birthday, had amassed a wealth of $100,000. He had tackled Charlie Munger's proclaimed challenging first financial hurdle of accumulating $100,000 by sticking rigidly to a financially disciplined lifestyle. Tom could now potentially relax slightly, unaware that a nearly 40% wealth reduction awaited him in just 2 years' time. Stage 3. Tom's roller coaster journey from $100,000 to $1 million. Can you hear it, Tom? Stephen's voice rang out through the phone. Nope. What's it? Exactly, interrupted Stephen. It's the silent purr of my brand new Tesla thanks to Walmeta going public. Although this isn't Tom's route to millions, it was for Stephen who hit a 2,400% return, catapulting his assets to $1.25 million. Tom, cautious with his $500 investment, pocketed a lesser yet considerable $12,000. Despite its sizable addition to his yearly savings, Tom couldn't shake a lingering sting of regret for not being bolder. $500? Wuss, echoed in his mind, challenging his adoption of Warren Buffett's wisdom that not all successful first tosses in investment guarantee profitable expectations in future rounds. He pondered, was Stephen's luck sustainable? Fast forward a few years, and Tom, now in his early 30s, found his financial path diverging sharply from his colleagues, including Stephen. Extravagant lifestyles, showcasing expensive possessions and experiences surrounded him. tempting him to abandon his financial prudence and demonstrate his own success through visible wealth. But he resisted, remembering a nugget of wisdom from a YouTube video. Real wealth isn't always visible. The unexpected descent of the stock market, slashing the S&P 500 by over 50% within a year, brought Tom technically back to stage 2 with his assets sinking below $100,000. But calmness prevailed in him. Echoing Benjamin Graham's advice to choose stocks like groceries, not perfume, Tom seized this moment of widespread discounts, investing shrewdly during the economic downturn and earning remarkable returns in the subsequent recovery years. Multiple life events converged when Tom was 33. His growing portfolio began outpacing his salary and contributing to his savings, despite average market returns around 10%. With a 2-year-old daughter, he and Sarah, now his wife, decided to invest in a home, recognizing the familial and psychological value in raising their child in a stable, dedicated space. Each invested $30,000 in a down payment, slowing, but not halting, the momentum of Tom's financial journey. A career shift came at 35 when Tom transitioned to Ford Motor for a 20% salary hike, though his portfolio occasionally outperformed his monthly salary and sometimes faced discouraging dips. It was a true test of endurance, where his investment practices could spell triumph or disaster. Maintaining consistency in his investment approach, Tom managed not just to navigate but also slightly outperform the market, turning an additional 4% annual profit into about $25,000 more than an average investor might acquire. With the ends of this stage in sight, Tom revisited a former passion: photography. He launched a small-scale wedding photography business, enabling him to indulge in a beloved hobby while also establishing an additional income stream, thereby easing the transition when he was finally ready to step away from his conventional job. Stage 4. Navigating through Tom's journey to financial independence. Tom successfully amasses $1 million and bids adieu to his conventional 9-to-5 career, ensuring a life fueled by his investments before hitting the age of 44. The majority, more than half of this financial cushion, was shaped by stock market returns, propelling him to this financial milestone a substantial 14 years earlier than if he had solely depended on his salary. With such financial backing, Tom was assured that his annual expenditures could be smoothly handled by his investment returns. Now Tom dedicates more of his time to things that truly ignite his joy: making investment moves in the stock market, embarking on hiking adventures, honing his photography skills, and most importantly, immersing himself in precious moments with family and friends, while also embracing his role as a splendid dad. Even venturing into becoming his daughter's tennis coach wasn't off the table. After all, a man's value is also mirrored through the time he invests in his family. In essence, Tom has become the master of his time, ensuring a steady flow of income while indulging more in his passions. A call to Stephen, an old friend he hadn't connected with in years, was due to share his uplifting news. "Hey, Stephen, can you hear that? Hey, Tom, it's been a while." "No, what is—" "Exactly, it's the silence of us not clocking into work on a typical Monday morning. Isn't it spectacular?" The joke, however, fell flat on Stephen. "Hey, is everything all right? Tom, remember Walmeta's soaring success?" "Of course. I retired on that wealth. You knew that, didn't you?" "Yes, Stephen. But then I reinvested that wealth into a company named Starburst." "Oof, unfortunate name." "Yes, it really is. They pledged to become the Starbucks of the metaverse. I placed my trust in them, but they nosedived. Returning to my previous job was a humbling experience. My retirement is an indistinct future now, unless I stumble upon a beyond meta, if such a thing exists." What makes this narrative extraordinary? Perhaps it's the sheer normality of it, which is exactly the point. A significant number of you could possibly out-earn Tom if you channel your efforts appropriately. A lot of you might garner better stock market returns if you're driven to. If the average Joe like Tom can secure financial independence by the tender age of 43, it's within your and my reach too. For a slightly more unconventional story, explore how Warren Buffett amassed his first $1 million by the time he was 31. Dive in! Cheers, everyone! At 43, Tom hangs up his professional boots at Ford Motor, a financial independence crafted through a blend of meticulous savings and intelligent stock market investments, despite stepping out of college without a dime to his name. His college journey at the University of Michigan, Dearborn, concluded at 23, where he majored in mechanical engineering, following in his father's footsteps. Securing a position at General Motors, even before donning his graduation cap, was lauded by his family. Yet internally, Tom pondered, is this it? From his initial days at General Motors, this introspection only deepened. His supervisor, James, who had garnered a golden watch for his lengthy service at the company, appeared content. However, Tom perceived it differently. Here was James in the same spot, doing the same things he did decades ago. While James prided himself on his watch, all Tom saw was a man dedicating his days to obligatory tasks, not his passions. Tom recognized this pattern from observing his father, who cherished his hiking expeditions yet was bound by a demanding work schedule, limiting his outings to once a month. The paradox was evident to Tom. The pursuit of money seemed to be costing them their true desires and joys. This video will unfold the 3 phases Tom traversed to attain financial independence, highlighting that varied facets are vital at different stages. Yet, one initial note is paramount. Without investing, relying purely on his engineering salary would have narrated this story at age 57, not 43. Through strategic investing, Tom managed to buy 14 years of life's most precious currency, time. Journey through Tom's focus as a stock market investor, his endeavors outside the investing realm, and perhaps most crucially, the paths he decided not to tread. Concluding stage, reflecting on Tom's financial journey and extending wisdom to you. Tom's voyage from a fresh graduate with empty pockets to a self-assured individual who achieved financial freedom at 43 unfurls a tapestry of strategic planning, wise investing, and an unwavering focus on a future shaped by his own hands. His transformation is not simply a testament to financial acumen, but a homage to prioritizing time, family, and genuine happiness above all. And here's where our shared narrative winds to its conclusion, yet also perhaps to your own beginning. Golden tip 1. Harness the power of investing. Just as Tom realized, investing wasn't merely about amassing wealth, but accelerating time towards financial freedom. Start early, delve into consistent investments, and allow the magical compound interest to weave its web. Whether it be the stock market, real estate, or any other avenue, ensure your money is working for you even while you slumber. Golden tip 2. Balance is key. A pivotal point from Tom's story emphasizes not merely securing financial stability, but ensuring a life well lived, brimming with memories, joy, and personal growth. Strive not just for a hefty bank account, but for rich experiences, intimate family moments, and pursuit of passions. Golden tip 3. Financial literacy is your compass. Educate yourself. Grasp the fundamentals of financial planning, budgeting, and investing. Knowledge fortifies you against risks and propels you towards informed, strategic decisions. Websites, courses, and books abound, offering wisdom to aid your journey. Golden tip 4. Cultivate multiple income streams. Like Tom, explore diverse avenues for income. While maintaining your primary job, dabble in side hustles, investments, or freelance projects. Secure financial foundations are often built upon varied income sources, safeguarding you against unforeseen circumstances. Golden tip 5. Align money with values. Remember Tom pondering over James's golden watch? Your wealth and time should be intricately tied to your values and desires. Allocate financial resources in a way that amplifies your happiness and is in tandem with your life's philosophies. Golden tip 6. Celebrate milestones, learn from missteps. Celebrate your financial victories, no matter how minor they might seem. Likewise, perceive missteps not as failures, but as invaluable lessons, just as Tom learned from Stephen's unfortunate investment in Starverse. Golden tip 7. Embrace change, adapt strategies. Just like the stock market, life too is replete with ups and downs. Be prepared to pivot your strategies, adapting to life's varied phases and challenges. Flexibility in your financial strategies ensures resilience against life's unforeseen quivers. In essence, Tom's saga mirrors a possibility, one where financial stability and heartfelt joy coexist harmoniously. Your journey, carved by your own hands, might be sprinkled with different decisions, varied pathways, and unique stories, yet the essence remains. Financial freedom is attainable, and it's not just about the money, it's about sculpting time, experiences, and life in your authentic mold. Here's to your journey. May it be uniquely yours, financially sound, and rich in moments that truly matter. Cheers to stepping into a future where your financial narrative is both a triumph and a repository of cherished memories. Dear viewers, if Tom's journey towards financial freedom enlightened or inspired you in any way, kindly grace us with a thumbs up and click the subscribe button to journey further with us through tales of finance, wisdom, and life's many adventures.